Welcome into a daily editorial here on the KE Report. In this daily editorial, I am joined by Jordan Roy-Byrne. He is the founder and editor of the Daily Gold. And Jordan, as much as we talk about the precious metals, which we're actually going to record a segment for the weekend show, what we're going to focus on is something that you brought up in your flash update to subscribers out today, and it talks about the bond market and also its correlation with the U.S. dollar. Essentially, yields are or have been inversely correlated to the U.S. dollar for pretty much over a year now. First and foremost, take us through what you found when you looked into this and found this correlation.
Well, Corey, looking at the important thing to note here with regard to the bond market is, first of all, it's getting really oversold, like the dollar. So both are due for a rally. We've already seen a little bit of a rally in the dollar. It's at least put in an interim low, and that could rally, maybe up to 92 to 93. That's what I'm looking for. But bonds I think they're going to start to rally very soon. And the reason why is they've become really oversold, and sentiment has become really bearish. For example, if you look at the daily sentiment index, last I checked, that was at 18% bulls for bonds, which is really low. And then also, if you look at a 20-day or 18-day moving average of that, it's basically at the same level. So sometimes when when you're looking at the daily sentiment index, and sometimes you'll see, as far as a bear reading, you'll see, 18 or 20% on the daily reading. But then if you look at a 20-day average, it might be 30 or 33 or 27, and that would tell you that, yes, sentiment is bearish, but it hasn't been bearish for that long. So in other words, when you see a really low reading in bonds as we have now, and then you see the 20-day moving average also have the same low reading, that tells you that the trend to the downside is probably exhausted or nearing exhaustion. And looking at the 5-year bond price, the 10-year bond price, and then the 30-year bond price, these have all had major breakdowns in the last couple of months. I mean, the 5-year bond has broken down to basically its lowest level since 09 or 10. The 10-year bond price has broken down to its lowest level since 2011. And the 30-year bond has broken down to its lowest levels since it looks like 2015 or possibly the end of 2014. And when you get a big break in one direction, Corey, you get a move and then you get a snapback and kind of a retest of the break. So technically, the bond market is setting up for a counter trend rally. And if that does take place, we could see these charts basically, or we could see these markets, all these bond prices rally back up to where they broke down, basically kind of retesting what was previous support and now is resistance. And, who knows, the retest could go on for a couple weeks or a couple months, maybe even longer. But eventually, that could lead to the next big wave down. And I think during that wave, that's when you're going to see precious metals really explode. But here and now, I'm getting ahead of myself. Here and now, we're probably going to start to rally in bonds. And the correlation with the dollar I think most of all of 2016 and most of 2017, the correlation was negative. In other words, when bonds would decline, the dollar would also. Excuse me, I have that backward. No.
Essentially, what you were showing everybody is through 2016 and through 2017, yields and the dollar were moving in, for the most part, the same direction. But once we hit kind of November, that correlation totally went out the window.
Right. Thank you very much. So we had that action going until basically, I think, November 2017. And that changed where now we see a positive correlation with respect to the bond price and the dollar. And again, the dollar has already rebounded and started to rally, and bond prices have not quite done so yet. But again, I think we're going to see them start to rally. And I mean, correlations or not, you shouldn't always invest with correlations, Corey. I mean, these people who are saying, well, gold is really the yen, just follow the yen. I mean, that drives me insane because it's totally incorrect. But I think it's important to understand like when correlations are changing. So you don't always want to use them as a timing indicator or to base all your decisions from. But when the correlation changes, and we've seen it with gold too. I mean, it makes sense because we're talking about this change. We've seen the same thing with gold, Corey, where gold has done well. I mean, it's rallied up to resistance with bonds selling off and not going up as they were previously. When you have that change in market action, it's important to note that. And that kind, what again, back to bonds, Corey, and with the dollar, what we're seeing here is a counter trend move, and getting to where gold is. We've kind of seen a failed breakout in the last couple of days, last week or so. Gold looks like it could correct for a little while. That jives with what we're seeing here in the dollar and in the bond market. So a lot of things to untangle, Corey, but I think that's, we're setting up here for a counter trend move in precious metals and a counter trend move in bonds, which would be a bond rally and a decline in yields.
Okay, so in summary, though, you are, it sounds like, expecting a bit of a retracement from the breakdown in, let's say, bond prices right now, but it's not necessarily a long-term change in direction. It's just one of these factors where markets don't move in straight lines, and after this recent breakdown in bonds, in the actual bond prices, we need a bit of a recovery to potentially continue that move down.
Yeah, absolutely. Very well said.
Okay. Well, when it comes to bonds, though, what is the big picture for you? Do you think even after this maybe short-term recovery in the bond price that we're going to continue this breakdown? There's many factors at play here, but in my eyes, at least, it does seem like this 10-year is going to make it to 3%, whether it's tomorrow or in a couple months.
Yeah, I mean, it's interesting because the bond prices and yields, they're basically opposite. But if you look at bond prices, they've already broken down to these major lows. I mean, the 10-year, as I said, it has broken down to basically the lowest levels since 2011. That's almost a 7-year low. And if you look at the 10-year yield, we have not seen that yet. The 10-year yield has to go above 3% in that high at the very beginning of 2014 for it to reach the same 7-year extreme. But as far as that breakout in the 10-year yield court, which is extremely important, by the way, the breakout in that, as far as moving above 3%, I don't see that coming now. I see that coming later after we get this retest of the breakdown, this retracement that you were talking about in bond prices. And if we do get that, that would mean that the 10-year sells off a little bit. I haven't checked it today, but yesterday it was 2.89%. So I would be really surprised, Corey, if the 10-year would break above that level in the next week or two. I think it's going to consolidate and come back a little bit and consolidate for maybe at least a couple months before it eventually makes that big move above 3%, which would be very bullish for precious metals. But in the very big picture, Corey, I do think long-term bonds they've made the bottom that we've all been waiting for many years, and that the major trend over the next 10, 20 years is now up. That doesn't mean their yields are going to go up every year, but where we are here and now, it looks like we're in the primary and the cyclical trend for long-term interest rates is up, and for long-term bond prices is down.
Okay, now as you said, there is this correlation, but don't always think that correlations hold true for long periods of time. What about the U.S. dollar? The U.S. dollar is bouncing a little bit today. It is still under 90 points on the dollar index. Tried to run just above there, but got topped out again at that number. It's still trading at the very bottom of its range. What is your forecast for the dollar?
My forecast would be over the next couple months, I think it could rally up to potentially 92, 93, those levels. I believe the 200-day moving average is, I want to say 93 or 94, but it's declining sharply. So the 200-day moving average in the next month or two, that should come to the 92, 93 level. And if the dollar rallies, as I'm expecting, we could see the dollar, make it up to that 92, 93 level where the 200-day moving average is. It's at 93.7, by the way. I was waiting for it to load. But a couple of reasons why I think the dollar is going to rally. We already touched on it with bonds. Secondly, precious metals have not broken out. Gold has failed to break out. Silver and the gold stocks, I mean, they're trading closer to lows than highs. So we talked about that last week. I mean, if we were going to have a major breakout in the market, we wouldn't be seeing the dollar, major breakout in precious metals. That is, we wouldn't see the dollar be firming up and rebounding here as it has. I mean, if you go back to the end of January, the dollar started to bounce from the low 88s. I mean, it tested it several times. Then it had a big rally up to 90.50. It came back down in the middle of this month, but it held support basically around, it looks like 88.50. So the dollar has tried to go below 88.50. If you're looking at a weekly chart, it probably shows twice. But if you're looking at a daily chart, I mean, you can see many tests of that level with two clear lows. And we've had a nice rally, not today, but the 2 days prior. Nothing that great, nothing that special in the dollar, to be honest. But again, like bonds, it's just gotten very oversold. I mean, sentiment is very bearish on the dollar. Obviously, it's not quite as bearish on the dollar as bonds, and that's because the dollar has stabilized in recent weeks. But Corey, it just got too stretched. It got too far below the moving averages. The 200-day, again, that's at 93.67. That's quite a bit above where the dollar is now. So I given what the intermarket analysis here, with no breakout in selling in precious metals and the sentiment in bonds and the probability of a retracement there, the dollar already firming, I mean, that tells me the dollar is more likely than not going to continue this rebound here. But again, I don't see anything that fantastic coming up for the dollar. I mean, I see a lot of resistance here. When I'm looking at the daily chart, I see a lot of resistance in the high 92s. So if the dollar does make it above 90.50, and that's the first upside target, I would look for it to reach 92 or the mid 92s.
Okay. Well, Jordan, I do appreciate you sharing some of your outlooks, but again, that dollar, even if it does reach 92 or the mid 92s, it's still, in my eyes, a pretty broken chart, and the direction continues to be down. But hey, it's not out of the question to get a little bit of a snapback rebound, much like bond prices, because of how negative people are in really both of those sectors. Jordan, great chatting with you. Thanks for your time, and have a great rest of your day.